CGS-CIMB is a leading integrated financial service provider in Asia. Through our network of local offices in Malaysia, Indonesia, Singapore, Thailand, branches and strategic partners, we have a global presence in over 20 countries, providing a truly Asian perspective. Our businesses include retail broking, institutional equities, derivatives, prime services, equities research, wealth management, and online broking. We also offer a range of Islamic services, such as Islamic stockbroking window, Islamic cross-border trading, Islamic securities selling and buying negotiated transaction. Backed by an award-winning research team, we have one of the most comprehensive research coverage of over 800 stocks in the region. Our strong research capabilities form the backbone of our product and service offerings, connecting clients to opportunities. CGS-CIMB, your financial gateway to Asia.
Think you're driven enough to succeed? Win a brand new Tesla Model 3 in just 3 easy steps. Open a CGS-CIMB trading account and start trading your way to awesome prizes. Participants can trade any of our 6 products to earn tickets. The more you trade, the better your chances. Earn as many tickets as possible from July to December to win the latest and greatest from Apple and be eligible for our grand prize, a Tesla Model 3. What's more, we've also lined up a series of webinars throughout the campaign period to help you become a savvier investor. Don't miss out on these free sessions. Register and level up your trading play. Open a CGS-CIMB account and start trading today.
Looking to access the U.S. market for all U.S.-listed stocks? Covering all U.S.-listed stock, Nasdaq Basic is the primary gateway for any firms accessing the U.S. equities market. We are helping and supporting any Asia-Pacific firms who need access to the U.S. market. With Nasdaq Basic, traders can access real-time U.S. equities quote and trade data cost-effectively and look at several key data elements for U.S. exchange-listed equities, including real-time best bid and offer, tick-by-tick price, and Nasdaq opening and closing prices, all at a fraction of the cost of consolidated alternatives. Nasdaq Basic is the leading exchange-provided alternative for real-time data coverage, includes NYSE, Nasdaq, and other U.S. exchanges, plus Nasdaq Basic can be implemented through a variety of investor tools, including watch lists, portfolio trackers, and dynamic tickers. To find out more, visit our website or email dataapac@nasdaq.com.
Welcome to CGS-CIMB, Asia's financial gateway. Here's how you can place an order with us. To open the order pad, tap on the menu button located at the upper right corner of the screen and select the search icon located at the bottom panel. You can search for your preferred stock in the search bar by entering its symbol or code. Tap to select on the stock you wish to trade from the search results. Then tap on Trade to open the order pad. Select your preferred trading account. Enter your desired quantity and price. Select your order type. Limit, stop limit, limit if touch. The validity period, day, FAK, FOK, GTD, GTM. Your preferred currency, SGD or traded market currency. And your payment type, cash, CUT, CPF, SRS. Tap on Buy or Sell. Enter the OTP verification code. Hit OK to proceed. check your order details and click Submit Order. Your order is now placed. On desktop, search for your preferred stock in the search bar by entering its symbol or code. Right-click on the selected stock. Click on the Buy or Sell button to open up the order pad. Select your preferred trading account. Enter the quantity and price of your order. Select your order type. The validity, the settlement currency, and lastly, your payment type. Click Buy or Sell. Check your order details and click OK once it is confirmed. Complete the OTP verification to complete your order. You can check your order status by clicking on the Order Book icon and select Order Status from the drop-down menu. Click on the order you would like to check by right-clicking on the order and select Order Details. A pop-up window will appear with complete details of your selected order. Thank you for choosing CGS-CIMB. Welcome to CGS-CIMB, Asia's financial gateway. Here's how you can check your order status. On mobile, tap on the menu tab and select Order Book. Tap on the order you would like to check to view your order details in full. You will be able to check the status of your order under Status. On desktop, head to the navigation bar. Click on Order Book. Select Order Status. Here, you can check your order details and order status under the Status column. Thank you for choosing CGS-CIMB.
CGS-CIMB is a leading integrated financial service provider in Asia. Through our network of local offices in Malaysia, Indonesia, Singapore, Thailand, branches and strategic partners, we have a global presence in over 20 countries, providing a truly Asian perspective. Our businesses include retail broking, institutional equities, derivatives, prime services, equities research, wealth management, and online broking. We also offer a range of Islamic services, such as Islamic stockbroking window, Islamic cross-border trading, Islamic securities selling and buying negotiated transaction. Backed by an award-winning research team, we have one of the most comprehensive research coverage of over 800 stocks in the region. Our strong research capabilities form the backbone of our product and service offerings, connecting clients to opportunities. CGS-CIMB, your financial gateway to Asia.
Think you're driven enough to succeed? Win a brand new Tesla Model 3 in just 3 easy steps. Open a CGS-CIMB trading account and start trading your way to awesome prizes. Participants can trade any of our 6 products to earn tickets. The more you trade, the better your chances. Earn as many tickets as possible from July to December to win the latest and greatest from Apple and be eligible for our grand prize, a Tesla Model 3. What's more, we've also lined up a series of webinars throughout the campaign period to help you become a savvier investor. Don't miss out on these free sessions. Register and level up your trading play. Open a CGS-CIMB account and start trading today.
Looking to access the U.S. market for all U.S. listed stocks? Covering all U.S. listed stock, Nasdaq Basic is the primary gateway for any firms accessing the U.S. equities market. We are helping and supporting any Asia-Pacific firms who need access to the U.S. market. With Nasdaq Basic, traders can access real-time U.S. equities quote and trade data cost-effectively and look at several key data elements for U.S. exchange-listed equities, including real-time best bid and offer, tick-by-tick price, and NASDAQ opening and closing prices, all at a fraction of the cost of consolidated alternatives. NASDAQ Basic is the leading exchange-provided alternative for real-time data coverage, includes NYSE, NASDAQ, and other U.S. exchanges, plus NASDAQ Basic can be implemented through a variety of investor tools, including watch lists, portfolio trackers, and dynamic tickers. To find out more, visit our website or email dataapac@nasdaq.com.
A good evening to all Driven to Learn attendees. Thank you so much for joining our webinar session tonight. My name is Josephine, and I'm a content strategist at CGS-CIMB Securities, Singapore. I'm very excited to be your host for this evening's session, Decoding US Stock Market Patterns with Technical Analysis. It's my first time hosting a session while we're Driven to Learn webinars, but tonight's speaker, Jay Gragnani, Head of Research and Client Engagement from Nasdaq Dorsey Wright, is no stranger to us. Here's a little info about Jay. He's been with the Nasdaq Dorsey Wright team since 2005 and has conducted training sessions with investors and financial professionals in North America, Europe, Asia, and the Middle East. Jay has also been an integral part of the research and product development team, helping to bring new products to the markets. Tonight, he's coming to us live virtually from Virginia. Hi, Jay. All right.
Josephine, great to see you.
Thank you. Great to see you too. All right, allow me to divulge just a little bit of background for tonight's session before passing the time over to you. This evening, Jay will be discussing the hows and whys of the point and figure analysis and will walk us through the benefits of using this charting methodology. Through point and figure analysis, investors can evaluate the relative strength of individual stocks, sectors, and asset classes from a technical aspect, which can be applied to analyze stocks in various markets worldwide. Questions revolving this P&F method came up a lot during our previous webinar session too. So I hope our viewers tonight are ready, because I certainly am. Do sit back, relax, and let's dive in. So Jay, over to you.
Great, thank you, and good evening, everybody. It's a pleasure to be here. Josephine, thank you so much for having me on the call this evening. And I'm really looking forward to talking to you about something that is very close and near and dear to my heart, and that is technical analysis. And technical analysis is a very broad term. There's lots of different forms and methods that go into technical analysis. And what I wanted to talk about specifically today is the point and figure method of technical analysis, how we apply it to markets, how we evaluate it with markets, and how we utilize it to make investment decisions, not only on the identifying stocks that we want to buy or sectors we want to buy or asset classes we want to buy, but also trying to understand when we want to sell those securities or those positions that we have. And so that's really what is near and dear to our heart. And when we talk about technical analysis, it is very much a two-sided coin. Look at stocks that we want to buy, but also knowing when to understand and when to sell those stocks. So let's jump right into it. And we'll jump right into it with the point and figure method of technical analysis. And I'll start with the idea that point and figure is nothing that Dorsey Wright created. Dorsey Wright as a firm has been around since 1987. We were acquired by Nasdaq about 6.5 years ago. And what we do today is very much what we have done for many, many years, and that is evaluate the price movement of securities, not only in isolation, but relative to each other. And at the end of the day, it comes down to supply and demand. It's the basic economic law of supply and demand that drives the price of goods that we consume on a day-to-day basis, but it's also the forces that drive the price movements of stocks over time. And so if you think about it for a second, if you think about what the law of supply and demand says, if there's more buyers out there for a particular good than there are sellers, then prices have to rise. If there's more sellers out there for a particular good than there are buyers, then prices have to fall. Buying and selling pressure are equal, then prices are going to remain the same. And that's the same forces that drive the goods that we consume, produce, whether it's goods that we're consuming for sports, whether it's cars, whether it's food, it doesn't matter what it is. At the end of the day, supply and demand is what's driving the price of those goods, and it's the same forces that are driving the price of stocks that trade on exchanges. Whether we're talking about individual stocks, sectors, asset classes, supply and demand is at the root of everything. And if there's more buyers for a particular good than there are sellers, if there's more for a good than there are buyers, then prices have to fall. And if buying and selling pressure are equal, then prices have to remain the same. And so just like produce rotates in and out of season in a grocery or a market, stocks and sectors and asset classes rotate in and out of season throughout the course of the stock market. How we understand and identify which stocks, which asset classes are in favor through the lens of the point and figure method analysis, which is nothing more than a logical, organized way of uncovering the imbalances between supply and demand in the marketplace. And so what we're looking at here on this chart is an original point and figure chart, which was created back in the late 1800s by Charles Dow. And Charles Dow was very much a fundamentalist at heart. He had an innate appreciation for understanding the fundamentals of a company, understanding the balance sheets, understanding all of the fundamental metrics of a company. But he also understood and wanted to know is the price action and the supply and demand aspect of the stock that sometimes can differ from the fundamentals of the company. And so that's where the form of point methodology came in, is from answering or looking at the question from a very different lens. The fundamentals answer the question of what companies we want to own, whereas the technical point methodology comes in and answers when do we want to own stock of those companies? Do those two things match up, or are they at an intersection point? And so when we look at this chart right here, what Charles Dow did back in the late 1800s is literally come in and write the price of the stock in it. So if you think about a chart paper, a piece of graph paper, and you write $40 in there, and if the stock moves up to 1, you write 41. If it moves up to 42, you write 42. And if it keeps moving up, you go on. And then as the stock begins to pull back, you move over and you begin to draw down. And what you could see on this particular chart is that each time the stock rallied, it tended to rally a little bit higher. And each time it pulled back, it didn't tend to pull back quite as far, suggesting that each rally, there was more net new demand driving the price of the stock up. And each pullback, there was less supply driving the price of the stock down, such that each rally carried with it more net new buyers for the particular stock. And so that was an original point and figure chart. And when we look at the modern day point and figure chart, we simply replaced all of those numbers embedded in the chart with X's and O's. And so it's really very simple. If we take a look, X's represent the price of a stock is rising, and O's represent the price of a stock is falling, then we can really begin to identify meaningful moves in the stock. And one of the big benefits of the point and figure methodology is that it helps alleviate or reduce some of the noise that might exist with other forms of technical analysis. And so if we look at every single stock in our system, and when I say every single stock, we not only track stocks that trade in the US, but we track about 26,000 securities, individual stocks that trade on stock exchanges all over the world, in the US, in Singapore, in Malaysia, in Europe, in South America, all over the world. We track stocks, about 26,000 individual stocks that trade all over the world. And we're able to do that because we're simply identifying the price movement of those stocks. And so if we look at these two examples, we can identify if on the left-hand side, a stock moves from $45 and it falls in a column of O's all the way down to $31. So again, a column of O's means that the price of the stock is falling from 45 all the way down to 31. At $31, the price of the stock stops falling. Something happens there that there's enough new demand, there's enough buyers that come in at $31 to drive the price of the stock back up, such that we need to move to the left-hand side of one column, reverse to a column of X's up to $34, and then we see 3 X's up at $34 because there's more demand that comes in for the stock. At $34, the price of the stock stops rising, which means there's not enough new demand to drive the price of the stock any higher. Sellers come in at $34, drive the price of the stock back down to 31. The chart moves over again to the right-hand side one time and down to $31. And once it's at $31, just like it did the previous time, there was enough new demand It came in for the price of the stock at $31 to drive the price of the stock back up to 34. We reverse up to 34. However, this time there's enough new demand, there's enough buyers willing to buy above $34. We hit 35 on the price of the stock, which is a column of X's that exceeded the previous column of X's. And that's important. That column of X's that exceeds the previous column of X's at the green arrow, the B, that is what we would call a buy signal. That would indicate that demand is in control of that stock because the rally was higher than the previous rally, which means there was more new buyers, there was more new demand for that price of the stock at $35 than there was the previous time, and we continue to see the price rise up to $41. So that move to $35 is what we would call a double top buy signal. The other side of the equation would be a sell signal, a double bottom sell signal. And it's the exact opposite. Now, I won't go through every single column, but it's very simply a column of O's at that big red arrow. The S just simply stands for sell, represents sell. S, a column of O's that exceeds or falls one box below the previous column of O's with $1 on the chart on the right-hand side. And so I wanted to bring this to your attention because these are the most basic patterns that we look at in the point and figure methodology, but it's also every single stock in our system falls into one of these two categories. Every single stock is either on a buy signal being controlled by demand, or it's on a sell signal being controlled by supply. And I bring that up to say that the point and figure methodology is not only a logical, organized way of uncovering the imbalances between supply and demand, but it's also a very much objective lens to identify which stocks are being controlled by demand, like the charts on the left-hand side, versus which stocks are being controlled by supply, like the charts on the right-hand side. And so this is something very important to keep in mind. And this is something that I will admit, I've been with Dorsey Wright and Associates for about 16 years now. And when I started charting these stocks by hand. And it's something that gave me an innate appreciation for understanding how these stocks moves. But I say that to say that is it a method that we could sit down and do by hand. We don't need to. Technology is what it is today. We don't need to do them by hand. But I tell you what, it gives you an incredible appreciation for understanding how the prices of these stocks move, and especially amongst some of the bigger holdings that you might be following. But this is an example of a modern day chart. If we look at just an example of Apple. And so there's some nuances that are embedded within the chart, and I won't try and get lost in the nuances of it. But again, a column of X's represents the price of the stock is rising. A column of O's represents the price of the stock is falling. And even in the case of Apple, what we have seen recently is that each rally has tended to be a little bit higher. Each pullback has tended to be a little bit lower, which means that upon each rally, there's been more new demand that has been driving the price of the stock higher and hitting new highs. And during each pullback, there hasn't been as many sellers or as much supply driving the price of the stock down. And that's an important thing to keep in mind, especially for a stock like Apple as it relates to the U.S. equity market or broad-based indexes. I mean, Apple is the most important stock, the biggest weighting in the S&P 500, Nasdaq 100. When you look inside it, you'll see some numbers embedded within there, and those are simply representative of the months of the year. So 1 would be January, 2 would be February, 3 would represent the first move of March of that year. And then to the extent that you see letters embedded in there, that simply represents October, November, December. A, B, and C is A is the 10th month of the year, which is October. B is November, which is the 11th month of the year. And C is December, which is the 12th month. So instead of trying to put 2 digits in each box, we just simply went 1 to 9 and then A, B, and C for October, November, and December. Note that those numbers that you see, those are just simply representative of the first move of that particular month. It's not that a stock has to move every single day or frankly every single month, but it's simply based on the action and the high and the low price for the day. So for example, if we're looking to the far right-hand side of this particular stock, we see at 148. If it didn't move up to 150 for a month, if it just kind of hung around the 148, 146 area, then you might not see a move on there for a month. But once it moves up to a particular to 150, then you would see an X added to the chart. And that's what we mean when we say that it removes some of the noise. It's not moving every single minute or every single second, or even frankly, every single day necessarily. It's moving based on the movement of the stock, which means it's moving only when it presents a material movement on the particular chart of that stock. And so this is, again, just the case of Apple. And again, this is a picture where, generally speaking, you see each rally, the stock rallies a little bit higher. Each pullback or each correction, you see it tends to pull back a little bit lower or a little bit higher than it did the previous, which means demand is in control of this particular stock as we go forward. And so, that's really what we're looking at. If we're looking at individual stocks, whether it's Apple or whether it's frankly any stock that you're evaluating, if you were to pull up a point and figure chart of the stock, you could get a very clear picture of, is demand in control of the stock or supply in control of that stock from an absolute perspective. So in general, is Apple moving higher in absolute price, or is Apple moving lower? And that's one side of the equation, one side of the picture that we attempt to answer. The other side of the equation that we attempt to answer is Apple outperforming other stocks? Or in other words, are there other stocks out there that we should be considering versus Apple or any other stock out there? In other words, what we want to look at is, momentum or relative strength. And I'll mention this before we kind of dig into the momentum picture for a second, but the momentum factor, and that's just one of those words, the momentum factor is one of those things out there that has shown a lot of history. There's a lot of academic research in it. This is part that utilizes the Ken French, which is a very, very widely used library and database of data that looks at momentum stocks. So if we were to buy high momentum stocks, that's the orange line there, versus just simply buying and holding the market. And basically what it identifies, it says that stocks that outperform are also the ones that historically have shown the potential to outperform on a go-forward basis. So yes, they outperform historically, but they're also the ones that have shown the ability to outperform going forward. It's very much like the laws of motion. Objects in motion and stay in motion until reacted on by an opposite force, right? And so stocks that tend to perform well tend to outperform on a go-forward basis, and that's what a lot of the academic research out there around momentum investing has displayed, and this is just one example of that. The biggest conundrum that I think a lot of investors face is, how do you identify those? Which stocks are good momentum stocks that are not just, quote unquote high flyers, but also ones that have good sound technicals around them. And the way that we look at it, we talk about it a lot as relative strength and momentum. Those two words get used interchangeably. But we very much look at it like a ranking system. The relative strength for us is nothing but leadership trends in the market in a very way to sports. And I think right now, especially with the Olympics going on, it's a great way to understand that how athletes make it to the Olympic Games. They don't make it to the Olympic Games because of their potential. They don't make it to the Olympic Games because of all of the their upbringing and their history and their families and their countries. They make it to the Olympic Games because they are the best athletes, because they perform on in the pool, in whatever medium it might be. If it's swimming, if it's track and field, the people that make it to the Olympics for track and field, they're going to the Olympics because they were the ones that ran the fastest. To the Olympics for swimming, they're the ones that are making it because they're swimming. And so if I'm putting together a portfolio of athletes, I want to put together a portfolio of athletes that have shown the potential, the ability to perform at their particular sport. Well, stock white, if you put together a portfolio of stocks that have shown the ability to actually perform, not potential, ability to actually perform. And that's what relative strength and momentum really is when we break it all down. At the end of the day, the calculation that we do that is really very simple. We take the price of a stock, we divide it by an index, we multiply, we take that and we get a relative reading. And that reading in and of itself, that reading in isolation doesn't really have any meaning until we put it onto a point and figure chart. And let's look at an example of what that means. The point and figure chart, I mentioned chart stocks by hand earlier. When I started 16 years ago, I was doing relative strength calculations by hand, and by hand, I mean with a calculator. But again, I say this to say that this is a calculation that you and we could do by hand. The technology allows us to do infinitely more calculations than we could ever do by hand. And so we don't need to, but I'm saying that because it is a very straightforward, a very simple calculation that we can do by hand. And then let's look at an example of that utilizing Bank of America. And Bank of America, obviously one of the largest financial companies, is if we were to take a relative strength chart and we were to say, okay, do we want to own shares of Bank of America? Or are we simply better off being invested in the broad U.S. equity market? Well, the way that we could identify that is we could take the price of Bank of America every night, we divide it by the S&P 500 equal weighted index, and we multiply that number by 100 and we get a reading. We then take that reading and plot it onto a point and figure chart. And that's what you're looking at here. So a column of X's here on a relative strength chart represents that Bank of America is outperforming the broad market. In other words, Bank of America is worth the single stock risk. If this chart begins to move lower in a column of O's, it suggests that Bank of America is beginning to underperform the market. What ultimately is meaningful to us here is the relative strength buy and sell signals on those charts. And so we can go through and we look, again, a buy signal, a column of X's exceeding the previous column of X's, a sell signal, column of O's exceeding the previous column of O's. We can look at this, and back in August of 2010, Bank of America gave a relative sell signal versus the equity market, which simply suggested that Bank of America was no longer worth the single stock risk. We were better off just simply spreading our chips across the table and buying the broad equity market. And from that point, for about 2 years until March of 2012, Bank of America fell another 28% while the market was up 25%. So we were far better off being just in the market than being exposed to the single stock risk of Bank of America. However, since then, since March of 2012, for going on 9 years now, Bank of America has just simply been the better investment. Bank of America has been worth the single stock risk. It's up 318%. The market's up about 200%. So everything has been up over the past 9 years, but Bank of America is a stock that has shown positive, strong relative strength and shown the ability, not potential, the actual ability to outperform over that time period. And so when we talk about relative strength, we're not talking about the direction of the move. We're talking about the magnitude of the move relative to, in this case, a particular benchmark. But let's say we had a universe of stocks. Let's say I didn't necessarily want to buy the market. Let's say I want to look at, how is one stock doing relative to another? Well, we can do that too. Let's take a look at Applied Materials versus Microsoft. And these are two stocks that are in that are some of the largest companies that trade in the U.S. equity market, and they're both members of the Nasdaq 100 index. Applied Materials versus Microsoft. So if I had laid everything out, I said, okay, which of these companies do we want to buy? I take the price of it, Applied Materials, I divide it by the price of Microsoft, and multiply that number by 100, plot that reading onto a relative strength chart. And what I can see here is a very clear picture of higher highs and higher lows, which means that Applied Materials, for the better part of the past years, really since June of 2020, so a little over a year now, Applied Materials has consistently outperformed that of Microsoft. Not to say that Microsoft has done bad, it's up 42%. Applied Materials is up 139% over that same time period. And so with relative strength, that's what we're looking to identify, is those leadership stocks within an inventory of securities that we're evaluating. This just happens to be 2 Nasdaq 100 stocks, and we could take that and we could apply it to a broader universe. You can see there in June 2020, that's where a column of X's exceeded the previous column of X's at that green box. And each time this chart rallied, it tended to rally a little bit higher. And each pullback, you didn't see it pull back to exceed a previous column of O's, which means it never gave a sell signal. It remained on a long-term relative strength buy signal for Applied Materials versus Microsoft during that time period. And so we could take inventory of stocks. We could take all stocks in the Nasdaq 100 as an example and compare each one versus every other one. So if we think about that for a second, if we say, let's take 100 stocks and compare those stocks to each other. So every single stock is going to be compared to each other. So Apple, Microsoft, those are the 2 biggest names in the index. They're going to get compared against every other stock. But so is Biogen, so is Moderna. Moderna is right at the forefront of the vaccines with everything going on in the COVID-19 pandemic. There's lots of companies, some of the most innovative companies in the world in the Nasdaq 100, but you compare all of those to each other. And at the end of the day, if you take 100 stocks and you compare each of those versus each other, what you're doing is 9,900 relative strength charts to get to this ranking of which stocks have the most relative strength buy signals versus every other stock. In other words, which stock has more wins? Which stock wins more games, wins more matches than any other stock out there? And that's what we call a relative strength matrix concept allows us to do, is identify just that. Which stocks, with respect to a particular universe, this happens to be the Nasdaq 100, you could do it on any universe that you would want to, whether it's Nasdaq 100, S&P 500, SGX index, it doesn't matter. Any index you want to do, you could compare all of those stocks versus each other and see which stocks have the most relative strength buy signals, i.e. most relative strength wins, which would mean those are the strongest stocks in the universe at 1 And so that's just an example of how we would construct that. And so if we were to do that, we've done a lot of work, and this is just an example of if we were to historically go back and take that Nasdaq 100 index and take that inventory of stocks within the Nasdaq 100, historically going back to 1999, and said, I want to buy the top quartile. In other words, if I were to buy the top 20% of the names, or out of 100 stocks, if I were to consistently just buy the top 20 names every single month, how would that do relative to just buying and holding the market? And that's that blue up top there. So since 99, so 21 years about, the top quartile, so the top 20% of those names has seen an average annualized return of about 13% versus about 7% for the Nasdaq 100. And that is tremendous. That is the potential opportunity that exists when we're able to identify those strong relative strength names in the marketplace and have a discipline to consistently convert and shift a portfolio into the leadership names, but at the same time have the discipline to sell those names that might fall out of that top quartile. But that is the potential. That's really what we're talking about when we think about identifying strong leadership stocks, is having a discipline, having a way to identify those leadership trends. So that's one way that we can identify stocks within our system, within our database. You have the ability to create custom relative strength matrices on any single inventory that you might want to. So that's one thing that you can do. Another tool that's available to you is what we call technical attributes. And for years, we've been applying this concept of a technical attribute reading to individual stocks that we have in our system. So within our system, every single stock has a technical grade 0 to 5, 5 being the strongest. So 5 is the best you can have, 0 is the worst you can have. 3 and better is what we would consider to be investment grade. So think about it for a second. There's 5 very specific criteria that we're looking at for an individual stock. If 3 or more are positive, that would be considered to be what we would call investment grade, or at least a hold to buy type of category. And very simply, all that means is that a majority of the attributes that we're evaluating are positive. Again, 5 is the strongest, 0 is the weakest. And if we look back over the past years, and so we've done a lot of work and a lot of looking at this and going back to, early 1990s, and said, okay, if we were to consistently buy a portfolio of all of the stocks that were rated 5, so strongest, compared to all of those that are rated 4s, strong, but next year down, 3s, again, still positive, but next year down, and then 2s, 1s, 0s, how did those perform? How did those stocks that have the strongest technical attribute rating of 5 perform over time versus the other attribute buckets, but also against just the broad market, against the S&P 500? And what we found, and you can see on the table here, is that what we classify as the strong attribute stocks, those that are 3, 4s, and 5s, those are the attribute readings that were the only 3 buckets that were able to consistently outperform the S&P 500 over time. The 3s at about a 9.5% average annualized return, 4s 10.2, 5s 12.2. So again, that's why the 5s are the strongest names. The 4s are very strong as well, and the 3s are certainly something that are above investment grade. And so this is, kind of the why we focus on buying those stocks with strong technical attributes. And I won't dig into what exactly goes into it. There's 5 very specific criteria. One of those is trend. The other 4 relate to the relative strength. So how is a stock doing relative to the overall market on a short and long-term basis? And how is a stock doing relative to its peers on a short and long-term basis? So those are the 5 attributes that we're looking at. So it's very heavily geared towards relative strength, but there's also an absolute trend component that digs in there. And so this is kind of the why we focus on the high attribute stocks. But it's not only about the return profile of it. It is, and what I mean by that is, yes, the 5s and the 4s, they have historically shown the potential to outperform and the ability to outperform the broad equity market. But what is incredibly interesting is that they've done so with less volatility over time. And so if we look at volatility just as defined by standard deviation, how much volatility a stock has, what we found is that the 0s, the stocks with the weakest attribute reading, that's the group of stocks that actually has the most or the highest amount of volatility or variability in returns. As a matter of fact, the 2s and 1s have, as well as the 0s, they all have higher volatility than the 3, 4s, and 5s, which have better returns. So in other words, by utilizing technical attributes within an investment process, you have the ability to potentially identify stocks that have higher returns with lower volatility over time. At the end of the day, that is that's ultimately what we're looking for. So, it's not only when we're looking at technical attributes, it's not only about performance side of things, but also about the volatility side of things as it relates to those technical attribute readings. And so this is the result of a white paper that we put out there. This is a public research piece. We're happy to send it to anybody that wants it. But this is, very, very important as it relates to identifying leadership trends in stocks, and then also identifying which stocks we want to invest in. And so if we bring that back for a second to just the equity markets, and I know the Nasdaq 100, the S&P 500 are the 2 biggest bellwether indexes as it relates to U.S. equity markets. There's a couple things that I think are worth pointing out today. Number one, 8 out of 10 of the top holdings of those 2 indexes are identical. 80% of the top 10 holdings of those two indexes are identical. So there's a handful of stocks that are very, very important to the movement of those indexes. Apple, Microsoft, Amazon, Facebook, obviously very, very important, the biggest top 4 holdings across those indexes. There's a couple that are different. For instance, in the S&P 500, you have Berkshire Hathaway as an example that's in there, you have Morgan that's in there, versus within the Nasdaq 100, you have PayPal, and you have Adobe as your other 2 stocks in there. But both cases, 9 out of 10 of the top 10 holdings are what we would consider to be strong technical attribute names. There's only one stock, and that's Tesla, that is actually considered to be a weak technical attribute name at just a 1 for 5. The others you'll see are 3, 4s, and 5s, Apple being a 3, Microsoft a 4, but they're all technically sound stocks. And that is not only speaks to the strength of the stocks, but also speaks to the strength of the health of the equity market. When you see those types of ratings across the top holdings of the indexes, that's a very, very strong sign for the equity market at large. And then you look at that as it relates to some individual names. And for those of you who tuned into our session last week, talking about some of the important stocks to watch, some of these big names, Facebook, Amazon, recently breaking out of these long periods of consolidation. Amazon, very specifically, a year-long period of consolidation, broke out, pulled back on some earnings news that happened last week, but still is very much holding support and still is very, very much a technically sound stock as it relates to the supply and demand efforts, where demand remains in control. The overall trends of these stocks remain positive. And just as it relates to the S&P 500, I think it's worth mentioning that about 82% of the stocks in the S&P 500 are in positive trends. And that in and of itself is a positive sign. As a matter of fact, any number that you see above 50% is historically a very, very positive sign for the equity market. A number of 82% is certainly a positive sign, as a vast majority of stocks are in positive trends. And the reality is the only way stocks stay in positive trends is to continue to move higher in absolute price. That's very much what you're seeing with stocks like Amazon, Facebook, as well as a lot of the top holdings within the Nasdaq 100, within the S&P 500 index. With that said, and as important as it is to identify the stocks that have the greatest potential to outperform on the upside, it's almost equally, if not more so important, to identify the other side of the equation of when is it time to sell these stocks? When do we want to get these stocks out of our portfolio? And we can use the point and figure method of technical analysis. We can use technical attributes to help manage risk in our portfolios. And one of those examples of that here recently is, what has happened with some of the Chinese equities, especially some of the ones that trade in the U.S., but obviously local shares as well. This is Alibaba, where Alibaba shares peaked back in October of 2020. And here we are in August, and just last month in July of 2021, and U.S. equity markets have continued to push and hit record new highs. Meanwhile, Alibaba is an example of a picture that is very opposite of what we've seen out of some of the stocks like in Apple, where it peaked in October, and October is that A in the chart. It peaked at 312, and each rally the stock has seen, it has tended to rally a little bit lower, which is very different than what we saw with stocks like in Apple, where each time Apple rallied, it tended to rally a little bit higher. But each time Baba tended to rally, it didn't rally quite as high, which meant that there was less demand driving the price higher during those rally periods. And you saw that in November, you saw that in February of this year, you saw that in April of this year. And so, you saw Alibaba back in November of last year move into a negative trend. It violated this red dotted line here. It violated that negative trend, but also it moved to what we would call a negative attribute position back in November and fell into a 2. And so Alibaba has fallen from 312 to about 192 recently. And so as important as it is to identify the strongest stocks that we want to invest in and we want to own, it's almost important, if not more so important, to identify when the leadership trends of those stocks have ended and time to move on. The case here with Alibaba, and you never know when it might happen. Oftentimes, the technicals lead the fundamentals, because what we're identifying, we're evaluating just the price movement of the securities. So we're just simply taking a consensus of the market, whether that's individual investors, whether that's insider traders, whether that's institutional investors that are casting their votes in the marketplace for what they believe to be the future prospects and current prospects of the individual stock. And if there's more sellers out there for that stock than there are buyers, then the prices are going to go down. And that's exactly what we've seen in the case of BABA for the better part of the past 7-8 months now. And so, as important as it is to utilize the point and figure methodology, utilize technical analysis, utilize the technical attributes to identify the leadership stocks that we want to own in our portfolio, it can be equally as beneficial to identify which stocks that we don't want to own in our portfolio to help avoid some of those losing positions there. So with that said, before we end it, I wanted to end this slide on, this is a snapshot as of through Friday's market action. So as up to date as I could get it, of the Nasdaq 100 relative strength matrix. So if I were to look at this is the top 12 stocks in the Nasdaq 100 today, based on the relative strength ranking. Moderna would be number 1, NVIDIA number 2. You see Atlassian at number 3, IDEX Corp, Alphabet in there at 5 and 6, and then ASML, DocuSign, so on and so forth. But so that is a tool that you have the ability within our research to create and construct and identify that on a very regular basis. So with that said, I'm going to wrap up my comments here. If you have any information, wanted to learn more, here's our contact information. You can sign up for a free trial of our research, reach out to us via email, phone number, or whatever the best method is to get in touch with us. But happy to have a conversation with you. Once again, appreciate all your time this evening. I know your time is valuable, so I appreciate you taking time out of your evening to join us and hear what we have to say. So with that said, Josie, I thank you for the time. I'm going to turn the call back over to you.
Okay, wow. Thank you, Jay. That was a very insightful macro view and introduction to the point and figure methodology, which I felt was presented in a way that even investors, new investors getting their feet wet, will be able to follow. And I can definitely feel your passion for PNF. 16 years, you did those calculations by hand, and you spoke with such conviction. And I also love your analogy of picking stocks akin to picking winners for the Olympics, right? So I do have some questions for you from the floor. Okay, so I like how you related how looking at daily relative strength calculation is akin to Newton's first law of motion. Objects in motion tends to stay in motion. And so the biggest conundrum, like you said, for investors is how do you identify high-flying stocks that have also sound technicals around them? So what would you say to somebody who wants to learn technical analysis in the stock market? Like, how would you advise that person to start?
That's a great question. I mean, technical analysis is such a broad term. There's lots of different forms of technical analysis out there. The form that we have gravitated towards is the point and figure method of technical analysis for a couple of reasons. One, as we alluded to, it is something that is very simple and straightforward to understand. It's something that helps reduce some of the noise that exists within the marketplace. And so I would say if you're looking specifically to understand the point and figure method of technical analysis as it relates to the stock market, there's a couple things that you could do. Number one, if you were to go to our website, we have a lot of educational resources and materials out there that are free, that you can get, that you can just learn about how point and figure chart works. And so that's probably one of the best sites. There's books that are published out there on point and figure methodology that were written by Tom Dorsey, who was one of the founders of Dorsey Wright and Associates. And so that's another great resource for you. But I would say those are probably the two biggest ones. If there's any other information, again, you can send us an email, contact us, and we can help point you in the right direction.
Okay, cool. I also noted that system hopping is one of the major problems in the 21st century relating to technical analysis, which means the trader switches from one system or strategy to another. What would you say are major issues to consider when you do technical analysis, or to niche down? What are some major issues to consider when you do PNF or even roadblocks?
Yeah, I would say that the system switching conundrum is very real and very detrimental. And when you try and go from one methodology to another methodology and back to another methodology, you're performance chasing, and that can be very, very problematic. I would say whether it's point and figure or something else. Point and figure, again, is something that we've gravitated to. It might be some other form of technical analysis or even fundamental analysis. Find something that you can believe in, that you can understand, that you can get behind, and have a deep understanding, a deep appreciation for how that methodology works. And if you can get to that point, then there's going to be periods where it might underperform for a near period, but then it'll, over time, if you have discipline, then it will be fine. And it's very akin. There's a portfolio manager, our head portfolio manager at Dorsey Wright, that runs a number of discretionary portfolios, describes this process as like a garden. Every single day you need to water the flowers and pull the weeds. And it's not necessarily always glamorous pulling the weeds, but it's a necessary thing that is part of portfolio management, is getting the weeds out of the portfolio and make sure you're watering the flowers. In other words, what that means is if you have a position in your portfolio that falls out of favor, is giving sell signals, is moving into negative trends, you need to take action on it. If you have stocks that are performing well, you want to nurture those. You want to let those stocks run. You want to let those, because that's over time, those are the stocks that can have a big impact on portfolio returns over time.
All right. Yeah, I remember what you said about Alibaba, the stock. It was going into a negative trend from its high last year in October, November. So I guess that's one sure way to know that you have to let go of a stock. One last question from me actually this evening. In your personal opinion, do you think technicals need fundamentals or vice versa?
Meet or beat?
Need. Like, do the technicals need the fundamentals?
Well, look, the technicals answer a very different yet very important question in the overall investment process. I think fundamentals are very, very important, but they answer a very different question. Fundamentals are going to answer what companies we want to own. They're going to look at the balance sheet. They're going to look at how much cash a company has on hand. They're going to look at the management, the board of directors. The fundamentals are going to really dig into the company and understand how sound that company is. The technicals are going to answer the question of what investors are doing with the stock. That can be very different. You can have an incredibly fundamentally sound company, but if investors don't recognize that, and if investors are selling that stock, then you don't want to own the stock. But vice versa, if the company is sound and investors recognize that, then the technicals are going to show that up. So I would say that it's very, very important. Fundamentals are very, very important. The technical side is very, very important, but they answer two very different questions, and I think they're equally important over time.
All right. Okay. Thank you so much for your input on that. I love how the way you just talk about why fundamentals are important and why technicals are important, and the fact that they answer, like you said, two very different questions. So thank you so much, Jay, coming to us all the way from Virginia. And before we end, it's your third and final webinar with us for CGS-CIMB's Driven campaign. I just would like to ask you, do you have any thoughts, any advice, anything you'd like to leave us with? We really appreciate your support for the past 2 months, and your sessions have been great. So, yeah.
Well, Josie, it's been a pleasure. I appreciate you having me on, and I appreciate taking the time. It's bittersweet. I enjoy doing this, and hopefully you'll invite me back to do some more conversations at some point in the near future, whether it's just talking about current market events or what's going on in the world of investing as it relates to the U.S. equity markets, or as we mentioned, we follow markets that trade all over around the world. So the only thing I can say is express my gratitude for being a part of these sessions. They have been phenomenal. The work that you and CGS-CIMB have put into this educational events speaks volumes to just the integrity of your business and how dedicated you are to providing education out there to investors, to your clients. And so, again, thank you so much for allowing me to be a part of it, and look forward to hopefully maybe being a part of some sessions in the near future.
All right. Okay, thank you so much, Jay, for all the hard work that you put into the slides, into the content. And yeah, you have provided so much value to us on the Driven to Learn series. So thank you very much once again from all of us at CGS-CIMB Securities. And we definitely look forward to working together with you and with Nasdaq Dorsey Wright again.
Sounds great.
All right.
Thank you so much.
Thank you, Jay. Thank you so much. All right. To our attendees, thank you again for tuning in tonight. Want to stand a chance to drive home a Tesla Model 3 and win the latest Apple products when you trade and invest with CGS-CIMB? Here's your chance. Scan the QR code to register now. Existing customers of CGS-CIMB Securities are automatically eligible when you trade or invest with us anywhere from 1st July to 31st December 2021. Stay up to date by following us on our socials: Facebook, Instagram, YouTube, Twitter, and LinkedIn. Our digital investing platform, Prosperous, is also on all social channels, and it is the latest rollout from CGS-CIMB Securities, a digital investment solution aimed at millennials. So we're all over on the socials, so do follow us for the latest updates on webinars, on our Driven campaign, and more. Last but not least, if you're hungry for more vouchers, don't forget to tune in to our next webinar for a chance to win yourself a $50 Takashimaya voucher. Only 100 attendees will win each month from July to December. So remember to opt in to the game in the Attendee Hub. Go to Community and click Join Game. Learn investing and go shopping with CGS-CIMB Driven to Learn webinars. Okay, that's all we have for tonight. Thank you very much for tuning in again, and I'm Josephine. See you in our next webinar session. Bye.